I am excited today because today is April 9th, and we are going to have a fantastic economic update today from Oscar Wei. I did say Wei correctly, right?
That's correct. Yes. Thank you, Chris, for having me.
No, absolutely. I mean, we are living in some very interesting times, and the stock market crashing and soaring and all kinds of things happening in the economy, interest rates diving and then uh, rising again. I mean, and this is all just in the last 8 days, right?
It happened very fast, and I think as you mentioned, in the last few days, there has been a lot of fluctuation, volatility in the market and in the stock market and interest rates. And I'm actually I'm glad that we're doing this again. I'm embarrassed to say that last time
Oscar,
because of the
so
outage.
just pretend that no one knows what happened last week, okay? No one knows that your power went out. You don't have to be embarrassed because we are going to have a great time. And a lot of stuff happened in the last week with
Right.
tariffs and stuff. So some of your thoughts that you were presenting last week before your power went out may have changed.
That's absolutely true, and then that's why I said, I'm glad that we have a chance to talk about it after a week, from last week because things have changed, and so now I'm still going to use most of the slides that I prepared before, but there will be some additional notes that I will add to the slides. So when you look at the visuals later on, you realize that okay, well, some of the things may not necessarily be exactly what is presented here. Just keep in mind, a lot of the statistics, as you probably know, from the economic standpoint of economic statistics standpoint, a lot of things are more backward looking. I'll add my forward looking comments to it. Hopefully, it will provide some insights as to what we can expect.
Perfect. So do me a quick favor and give me like three major bullet points of things, highlights that you're going to cover in the next, what, about an hour?
About an hour and 15 minutes or so, yes.
Yeah.
So let's start off with, of course, I will reiterate that
So,
uncertainty. Yes,
Oscar,
go
we're
ahead.
just teasing people here. So, just quickly, three
Sure.
three quick bullets, and as soon as we're done with that, I'm going to do a quick intro to the RCAOC, and then we'll launch into your presentation.
Absolutely. Well, the very first bullet point I would say is, the uncertainty is definitely continue to be a theme, and there will be a lot of things that people will not be sure. So, hang tight. The second item that I want to bring up is we are going to see. I want to say, as far as interest rate is concerned, we most likely will see a dip in interest rates, but probably not a whole lot. That is going to affect both the housing market as well as the commercial real estate market. And then the third thing is, of course, everyone is concerned about whether we are going to see a recessions. The chance of recessions probably is a little bit higher, and that definitely is going to affect, the economy as well as the CRE sector.
Now, we talked on the phone after your power went out last time, and we talked about having a little bit of interactivity while we're streaming on YouTube.
Hmm.
And so this will be a little bit different. We're trying an experiment here. And so I'll do a quick introduction to the RCAOC. Then I made you a co-host, so you'll be able to share your screen.
Sure.
So as soon as we get through the presentation, then we'll have you share your screen, and we'll launch into this. And you're going to be doing most of the talking, but I might pop in every once in a while with some color commentary. Okay.
Absolutely. Yes, please do so.
All right. This is going to be fun. All right, everyone. Welcome to the RCAOC live stream commercial real estate economic update. And as everyone knows, this is April 9th, 2025. We're doing this at 8:30 a.m. Pacific time. And because this is a live stream streaming on YouTube, anyone can come back and watch this again and again. And we'll have history memorialized. So we'll have to come back to this in 6 months, Oscar, and say, all right, so you made these projections on April 9th, and here we are in, I don't know, maybe September or October. And how did things turn out, and how do your projections change? Does that sound like a plan?
That does sound like a plan, and hopefully, of course, we have a little bit more certainty in 6 months. But then, yes, we are going through a really interesting time right now.
Yeah. All right. So let's go ahead and go to the mission statement. The Realtors Commercial Alliance of Orange County, California, is the only commercial association of realtors in the state of California. And our mission statement is to empower our members to thrive in commercial real estate through education, networking, and fostering collaboration among commercial, residential professionals, and business brokers. So, we're not here for residential. We're here for the commercial, the business to business market, not the business to consumer market. And our board of directors this year for 2025, I'm the president, Chris Vogt. Our secretary treasurer is Helen Jeong, and Matt Cortez is our director at large. I'm also serving as our association executive. So some of the benefits of becoming part of the RCAOC is we do a monthly commercial real estate networking Zoom. And if you're listening to this live stream and you're listening before our event next week, that'll be awesome. If you're listening after, then we do invite you to check out our website to see what our next things are. We are looking to do some social events in Southern California, Orange County specifically, later this year. And we also have a member hotline where members can call in and we will briefly, without getting into specifics of a deal and stuff, discuss things that you might need to know to be successful in commercial real estate. And the member hotline is a Google Voice number. It is not answered. So if you call up expecting to talk to a human, we do prefer that you either leave a voice message or even better, just send a text message to us at 949-371-6611. That's 949-371-6611. And if you'd like to learn more about the Realtors Commercial Alliance, please check out our website at rcaoc.org. And coming up, we have our Mingle coming up next week, actually. And the Mingle is going to be live on Zoom. And if you would like to participate in that, just pop us a text message on the phone number and we can invite list. And we do this the third Wednesday of every month. And of course, we always like to express our appreciation for our sponsors, Minis Property Management and Revy Real Estate Education. So please highlight and make a note of our sponsors. And if you need property management in the Orange County area of California, or if you are looking for real estate education, Revy is one of the providers for the California real estate licensing continue ed. All right, so that is our quick introduction. And Oscar, it's your turn to share. And while you're doing that, I met Oscar in Pasadena. I don't remember if I met you once or twice, like last year definitely, and maybe the year before also. And so um, Oscar is the Deputy Chief Economist, is that correct?
That's correct. Yes.
Yeah, for the California Association of Realtors. He spends most of his time looking at residential real estate and the trends and everything related to that. But as the only commercial real estate association in California, or Real Association of Realtors in California, we are excited to give him a challenge every once in a while to tap into his knowledge and expertise and apply it to commercial real estate. So thank you and welcome.
Thank you, Chris, for having me. Yes, I focus more on residential, but of course, when we talk about residential, because I'm an economist, I look at, all the, economic update, macroeconomic updates and things like that. And of course, many of those actually apply to the commercial side as well. And in fact, many of the things that, we covered will be Of course, I'm going to start off with like a brief, maybe macroeconomic introductions, background information about what's going on right now, or actually what happened, I should say, maybe a month, 2 months ago, just to give a set a tone to it before we get into it. So yes, this is definitely something that I don't do on a regular basis, but I do commercial every now and then. So let's get started. Let's take a look at some of the information
Hey,
that,
Oscar,
yes.
before we get going, we do have people watching on our live stream.
Uh-huh.
And if you're watching the live stream, do a quick favor and just put into the chat where you're watching from,
Mhm.
because I'd really like to know where you're watching from, because we did make some announcements that went clear out across the United States and a lot of people in California also.
Perfect. Yeah. So, all the information that I am sharing, um, obviously, I have some information primarily in for Californians, but of course, we have a lot of national and macroeconomics statistics that apply to, the nation as a whole. But most of the information I will be extracting or pulling from, or pulled from, would be from the for the U.S. as a whole. So let's get started. Let's talk about, what's going on, what let's as I mentioned earlier, some of the statistics that we're going to look at, they will be backward looking. That again, gives us some idea about what happened before the last few weeks. So let's take a look at the economy. Of course, the latest information that we have, typically the U.S. GDP numbers, the economic activities data for the GDP, they get released every quarter. So you can take a look at the slide right here on the screen. It shows you the economic activity in terms of percent growth of GDP. That shows you, how much the economy has been growing. Now, if you look at it from a standpoint of, what happened in the last, or historically, what happened, and maybe in the last 30 years, 40 years, 50 years or so, to keep up with population growth, typically we need maybe about 3% or so. Now, we have been increasing at a pretty decent rate. Uh, we have been talking, you have heard about people saying, hey, we might actually have a recessions or soft landing last year or maybe even the year before because of some of the weaknesses that we have seen. But so far, at least up to the fourth quarter, we had not seen a recessions for maybe about 2 years, 3 years, 4 years or so since COVID. So let's take a look at the last quarter. The latest quarterly number that we saw came in a little lower at 2.3%. 2.3% definitely was a number lower than the previous quarter at 3.1%. And people expected things to be a little slow, but it still came in a little bit lower than the consensus expectation of 2.6%. So it's expected, after the fourth quarter, it's expected the first quarter of this year maybe will continue to slow down a little bit, but remain to be a positive number. Now, um, for the year as a whole, 2024, we still came in with a pretty positive number, close to that 3% that I mentioned. In fact, it came in at 2.8%. And it's, we have to give credit when credit's due. It's because of consumer spending. They were pretty resilient, especially at the end of the fourth quarter. The end of the fourth quarter, they actually increased at a pretty decent rate. In fact, the fourth quarter as a whole increased at 4.2%, which was actually the fastest rate since the first quarter of 2023. Now, the reason why consumers remain pretty resilient at the end of last year, part of it is because they could be concerned about what could happen in 2025. Will interest rates actually increase because of inflation? And there had been talked about tariffs. So people they were already aware. They were aware of that possibility that some of the big ticketed items and maybe vehicles, automobiles could actually increase in terms of price. So some people might have pulled forward, at the end of last year, maybe in December or so. So we had a pretty decent holiday season spending, so that actually pushed the fourth quarter number a little bit higher. Now, on the other hand, in addition to the economic activity from consumers, we also have businesses spending and also government spending that's accounted for as part of the gross domestic product or GDP. Business spending though did actually drop. partly because of hurricanes in October. And remember, we had some strikes at the end of last year that caused, the business investment to actually decline. And of course, on the government spending side, it actually increased at the end of last year. But when you look at it, the year as a whole, things seem to be actually doing okay. Now, in addition to looking at the economic growth, a lot of time, economists look at, how many jobs being created as well. Let's take a look at the slide right here that shows you the labor market. If you look at the labor market, this shows you the number of jobs being created in the US all the way up to February 2025. We have been seeing, if you go back, to 2 years ago, you can see that, generally we're seeing a slightly declining trend. I should say slightly. It's actually started declining pretty sharply in 2022, and rightfully so because we actually had a pretty big jump in 2021, 2022, because people, we came back from COVID, from the shutdown. Now, in the last year or so, or 12 months or so, I should say, um, well, let's backtrack a little bit. In 2023, we might have an average monthly increase of close to 250,000. And then in 2024, it came down to maybe about 200, maybe a little bit below 200. So far, I think in the last, 6 months or so, we might have been growing at around 150,000, 160,000 or so per month, which is not a bad, job growth because when you compare it to the pre-pandemic level, we were right about 150, 160,000 or so. So if we continue to grow at a 150,000 job growth rate, that will be, consistent with historical trend, and it's considered pretty decent. But we did have a
Oscar,
yes.
so it seems like I just heard on the news that the March numbers were just released and the February numbers were released in March. Oh, you have February there. But weren't they like 235,000 private sector jobs created in
Um,
March? Something
not
like that?
not really, not really. I haven't looked at the March number. Maybe actually, I take that back. Actually, March number did increase. I actually wrote about it. The March growth, and I'm glad that you brought it up, Chris. I think I kept the same slide here. I didn't update it, from when I actually put it together for the very first presentation. And you're right.
Right.
It came out, at 100 at about 230, 240,000. It actually came out to be a little bit stronger than what people anticipated. Now, um, people were actually accounting for that there might be some drop off in the government sectors because of what we have experienced since the
The
inaugurations at
Doge.
the beginning of this year. So we were expecting, the economists were expecting maybe some effect, but the effect actually was not that great so far. If you think about it, government sectors, government layoffs, government jobs may have accounted for 2-3%, depending on how what you want to look at. If you look at the federal government jobs, it might have accounted for 2, 3, 4, 5% of the total workforce, and we did have some layoffs. Those layoffs may not necessarily show up all at once in March. We probably will continue to see some increase in some of the decline in job losses. Now, when you look at it from that standpoint, yes, you might actually feel a little bit more relieved because Doge, was supposed to, with the mass layoffs that we were seeing, we were concerned that maybe there might be a lot more unemployment rate. Now, unemployment rate though, did increase from 4.1% in February to 4.2% in March. So I'm glad that you brought that up because it did inch up. But again, from the economist perspective, inching up from 4.1 to 4.2% actually is not too bad, especially since when you look at those numbers, scrutinize those numbers, they actually could be, sort of like a statistical rounding of some of the numbers. So a slight inch up is not too concerning. But of course, as I mentioned, there are areas that we should be a little bit pay more attention to. There are areas that I think in the upcoming months we will be seeing a little bit more either job being lost or even the number that we might be seeing later this week. job claims, there's another measure that people look at, unemployment jobless claim, or unemployment benefits claims. Those are things that we probably need to look at. And I anticipate in the upcoming weeks that we will be seeing some insurance jobless claims start rising a little bit because of concerns about because of small companies or maybe even bigger companies started actually tightening up their job hiring. And so be on the lookout for some of those numbers. So I'm glad that you brought that up. Now, um, another measure that actually will have an update is the CPI number, the inflation number. Now, what I have here is the latest that I can grab my hands on. But tomorrow, I believe, is going to be another release on the inflation number. So that will be interesting. Inflation number is something that we want to take a look at as well. Now, we talked about economic growth. We talk about the unemployment rate or labor market. Inflation number is like the third item that people want to take a look at and have been paying attention to. And if you're not if you have not been paying attention to the general inflation number, you must be paying attention to some of the other things like eggs, of course. Egg prices have been talked about a lot. Take a look at the chart right here. Egg prices compared to a year ago, you can see that it actually increased almost 60% compared to a year ago. But, I think I've heard that, egg prices actually start coming down a little bit, in the last few weeks or so. So in the upcoming inflation report, the consumer price index report that we will see tomorrow, most likely we will see a little bit of relief on some of the egg prices and some of the other items. But egg prices is actually eggs may not necessarily be the entire story. If you take a look at, some of the other items, for example, auto insurance. If you take a look at utility gas, those are items that continue to grow. We're actually seeing on auto insurance, some of you experienced the pain of 11%, compared to a year ago. But overall, if you just look at the overall number, that latest inflation number from February actually was not too bad. If you look at the core inflation, which is the gray line right here, that's the number that economists focus on. That's the number that actually takes away the more volatile item like gas and or energy and prices. That number actually came down to 3.1%, which was actually not a bad number. In fact, that's a number that is encouraging. But of course, keep in mind the upcoming numbers, I said that earlier, this is backward looking. In the upcoming month or so, we probably will see a little bit of increase because of all the tariffs. And I'll emphasize a lot more on tariffs later on. And of course, that actually brings us to the next slide, which is about interest rates. What happened with interest rates, with inflations? Now, those numbers that I show you on inflation, those are numbers that probably they're right in this little circle right here in red. But this effect mostly what we're seeing maybe in February and maybe a little bit in early March. What happened in the last few weeks? We definitely have been experiencing some big ups and downs in the past few days. Some of you already noticed. I think a few days ago. We actually saw, when the announcement of tariffs, the sweeping tariffs got announced, we actually had a significant dip in interest rates. The 30-year fixed rate at one point, I think it was maybe last Friday, maybe last Thursday, we actually saw interest rate went all the way down to, for the average 30-year, went all the way down to maybe about 6.6 or so. But then the last couple of days it started rising a little bit. Now I'll explain a little bit more about what happened. Um, First, the big dip, partly because of concerns that the economy could be going into recessions and the stock market and actually move. A lot of people in the stock market actually move their money to the bond market, creating a demand for bond actually lead to the because they want to move it to the safer haven. So bond prices went up and then interest rate came back down. But then at the last few days, there has been a little bit more concerns about, okay, well, it looks like there is it is a reality. The recessions, odds of recessions actually have increased by, you can hear that from JP Morgan, Morgan Stanley might have increased their odds of recessions. So it's getting real. That also means if we are actually having trade war with many countries, um, at the same time, that also means that revenue, even though we are actually having additional tariff revenue, but because we're trading less, revenue actually could be less than what was projected. That actually means the Department of Treasury, maybe the Federal Reserve may actually have to issue more Treasury bonds that actually will increase yields a little bit, and that actually prompted, interest rates to increase in the last couple of days. There are a lot to it, but in the last couple of days, maybe even today, we might actually see an inch up in interest rates. But of course, there are a lot of moving parts. I give you a glimpse of what happened in interest rates that actually suggest, there might be a little bit more volatility in the making in the next few couple months or so, or maybe in the next few months. Now, before we talk about the outlook, let me give you again. We just went through, some background information, some backward-looking information on the economy to set the stage. Let's take a look at the CRE sector. Um, all these numbers that I'm going to show you in in the next 20 slides or so, they are again based on some numbers that we saw in a few months ago because those are collected, typically on a quarterly basis. Then I'll jump in in the outlook sector and talk about what we can expect. So let's take a look at, the CRE sector first. If you look at, the numbers here, I'm showing the transactions figures as well as the CRE um, change in the transaction volume. Now, on a quarterly basis, you can see in the fourth quarter, we actually did a pretty good fourth quarter. Now, I'm focusing on, four different types of properties, four different types of CRE properties: apartments, industrial space, retail space, and office space. You can see on a year-over-year basis, partly because, in 2023, last quarter of 2023, maybe the market was not great. But in the fourth quarter, look at, the increase in transaction volumes. Apartment, the industrial, retail, office space, all increase, with multifamily actually increasing 64% compared to a year ago. And industrial space and office space also improved. Retail space actually only increased 8.1%, partly because of tight supply. So all in all, I think transaction volumes improved. We had in the last quarter of this year, of 2024, it is also possible that people feel like, at the end of last year, after the election, people might feel like, oh, okay, maybe we will have fewer regulations, in the upcoming couple years, in the upcoming 4 years. So people might be a little bit more motivated to get back into the CRE sector. So that could be part of the reason. Um, and if you look at the CRE prices, I have a number that shows you the aggregated price index, and you can see it at the end of last year. Um, we actually start seeing some increased in at the beginning of 2024, and then in the last couple more months or so, we actually started seeing some flatlining. Um, Prices start stabilizing a little bit for the aggregate. If you look at the individual price indices by type, and again, I want to give credit when credit is due. I grabbed these numbers from Green Street as well as from Real Capital Analytics and Wells Fargo. So you can see some of these numbers right here. If you look at multifamily, which is the dark red line right here, it is still a decline compared to a year ago. It's actually dropped by 4.2% as far as the price index. But you can also see that it actually has been improving in terms of the decline. In terms of the year-over-year drop, it's actually not dropping as much. And same for the other property type, retail. I'm sorry, for office as well as for both types of office. Um, they actually continue to decline, but at a more moderate pace. So that's good news because things are actually stabilizing, and they're actually coming back up. Now, office sectors you will focus more later on. You can tell that it's still struggling a little bit. We'll have another year of negative growth in the office sector. But apartment or multifamily, it's primarily because of supply. But supply is going to tighten up a little bit, even though we're going to see more supply, new supply coming on board. Probably we'll see a little bit tightening this year. But that was all before, of course, the tariff situations. We'll talk more about this tariff situation and take a look at the retail and industrial. Um, at least at the end of last year, they continue to grow at a decent pace. 3% for retail space and close to 3% for industrial. So it was going well at the end of last year, but of course, things actually might change a little bit. Now, let's take a look at, what happened with individual sectors. Let's start off with multifamily, and that's because, I'm more a residential guy, as Chris mentioned. So let's start off with multifamily. But before we talk about multifamily, obviously, we have to look at, what happened with the housing market because that affects, apartments and rental market. Um, Many of you have been paying attention to, the housing market, home sales. Probably noticed as far as, the housing market in California is concerned, it's very similar, trending similar to the national housing market, and it has a lot to do, of course, with interest rates. Interest rates staying at a very high level compared to the pre-pandemic level of 3% or so, or I shouldn't say pre-pandemic level, but in 2020 and 2021, we had 3%, probably once of a lifetime rate level, but it started rising at a pretty fast pace, in the last couple of years, got up to close to 8% at one point for average 30-year fixed rate, and then recently it moderated to maybe about 6.7 or so. And because of rate remaining at a high level, take a look at these numbers. For home sales, existing home sales, it actually increased slightly with the latest number, February number. We're working on our March number, but with a February number, these are the numbers that we have. 2.6% increase in sales compared to a year ago. A very, very small increase compared to a year ago. Now, for many of you who have been paying attention to home sales, historically, you probably notice that this is actually very low compared to the historical number. We typically have about 400,000 sales on average. So this is actually very low compared to that level. We will continue to improve throughout the year, but probably not going to get too far. We probably won't get to about 400 or close to 400 this year. And as far as price is concerned, we actually inched up by about 3%. Single family homes actually have been increasing at a faster pace, but I see that things are actually moderating a little bit. And as far as price growth is concerned, partly because we're seeing a little bit more supply. Um, we have been seeing more supply, maybe about 10 to 15% increase in housing supply, because first, people actually did not want to release their property, did not want to put the house up on the market because of what we call the lock-in effect, which is they lock in at 3% in 2021, 2022. If they were to actually sell the property and buy a new one, they have to finance it with a higher cost, and people were not willing to do that. So interest
So,
rates,
Oscar,
yes.
before you move
Uh-huh.
on that last slide, can you
Sure.
tell us how we compare to historic norms as far as the number of months unsold inventory and median days on market?
That's a good question, and I should have mentioned that too. Now, if you look at the historical norm, of course, the historical norm could be from 1980 to 1990, or also could be from 2000 to 2020, 2020. But let's look at the last 20 years before the COVID. If you look at 2020 through 2020, 2000 to through 2020, the unsold inventory index or months of index is probably somewhere around 5 months or so. Now, it's only for California, and it's only a little bit above, what we are seeing here in this index here at 4 months. Um, so we actually have been California actually has had a very tight market in the last 20 years, but before February, in fact, you can see that the year-over-year growth rate right here says 38% or close to 38%. So before February, we actually had a month that is very low at below 3 months of inventory, 2.5, 2.8 months of inventory. So we are getting actually back to a little closer to that norm of 5 months. But we're not going to get there. And most likely, if we have a decent home buying season in the spring, this number will actually dip again to maybe about 3.5%, 3.5 months or so. So we're definitely below, the norm by maybe about a month or two. So we still have to, try to catch up. Now, as far as median days on market is concerned, the days on market, median days on market does not account for days in escrow. So it only accounts for, when someone lists a property on the market to when it open escrow. Typically, it is about 20, 25 days or so. Historically, I should say, we have seen, depending on the area, in the Bay Area, for example, we actually have seen only 10 days, maybe even 8 days. But for the state as a whole, maybe about 20, 25 days. That's actually about right. So I don't think the median days on market actually changed a whole lot in the last 6 months compared to the historical norm. It did change probably in 2022, 2023, actually prior to 2022, when we had the 3% interest rate, they were, flying off the shelf pretty fast. And then in 2023, 2024, actually inched back up to somewhat closer to the historical norm. So now, as we move into again the upcoming home buying season, depending on how the economy behaves and depending on how interest rate behave, that will actually lead to most likely seasonal adjustment. Well, seasonality suggests that will lead to a slightly lower number of median days on market, but we'll see how that goes.
Okay, great. And for those of you who are watching live, or if you're even watching the recording of this, please put what is your specialty in real estate? First of all, are you a realtor? Are you a commercial broker? Are you an investor? Or are you just you stumbled across this broadcast as someone who's not a real estate professional? Just let us know what is your relationship to the market, so that we know who's there because we're going to be looking at this information as we do future broadcasts also. And
Absolutely, yes.
if you are watching live, feel free to put questions in the chat. And at the end of this, we will be addressing some questions that are showing up in the chat.
Perfect. And that definitely will help, our future presentation as well. As Chris mentioned, I think it will give me an idea of what I should actually put on the slides. So let's take a look at some of the other additional information that I mentioned, but may not have show you a visual. Now, if you look at, the interest rates, I mentioned about interest rates rising. Take a look at the price growth versus mortgage payment growth up on here. I'll focus on the orange line. The orange line shows you that, because of interest rate rise had been rising, but then they start, slowing or moderating a little bit. We have been seeing some fluctuations in mortgage payment. It's not a surprise. In 2023, we saw a significant increase in mortgage payment growth because of increase in mortgage rates. But then it actually started dipping, and it was pretty hopeful, at the end of last year, in the third quarter, that maybe, it's actually finally started actually dropping, uh, and cost less to finance a home or buy a home. But then it's actually started bouncing back because interest rates started rising again. Um, that actually led to, of course, people paying a lot more on monthly mortgage payment. If you look at the 2020 number for monthly median mortgage compared to 2024, you can see there's a significant difference, almost like 60% increase compared to, what we saw in 2020. And that's one of the reason why, it's create some affordability issue. Here's a number that shows you the percent of people, or percent of households, I should say, that can afford to buy a median price home. Now, when you hear the word median, typically that's mean right in the middle, right? So you know, people are, when we look at median price, people might think, well, maybe about close to 50% of the households can afford to buy a median price home. But the reality is in California, only about 15% of all households can afford to buy a median price home. So that's a very, very low number. And that's one of the reason why we have a lot of people who rent in the rental market, in the apartment multifamily market. Now,
So before you move on to
sure.
vacancy, so there's been a lot of talk, both in residential and commercial real estate,
Uh-huh.
about the insurance crisis and looking at what insurance rates have done. For example, on my house, this month my premium has increased to $8,500 for the year. Last year it was 8,000. 2 years ago it was like 4,500. The year before that it was like 2,400. Before that it was around $2,000. So, personally, I've seen my own um, insurance premiums increase, 400%, over 400% just in the last 4 years.
Absolutely. I mean, I think yeah, I'm glad that you brought that up. Insurance is a big cost, had turned out to be a big part of cost of maintaining a house in the last, what, 3, 4 years. Um, 400% increase is definitely a significant increase. I've seen some numbers on home insurance costs, and some numbers being published by the Department of Insurance. It shows that for some of the insurance company, they requested to increase insurance, ranging from an increase in premium by even a 0% all the way up to 600%. So your 400% is more on the upside, Chris. Um,
Yeah, it
and
is
and
definitely on the upside.
and of course, but there are a lot of people who will be even, increasing, let's say 100% from, let's say, couple $1,000s to 4,000. That is a significant increase because it adds another 200, $300 every month, on
Mhm.
your monthly expenses. And that, of course, makes housing a bit more not affordable, and people have to turn to, multifamily apartment to rent. And that's
Well,
a
and
good
multifamily
reason.
insurance rates have gone through the roof too, which is affecting rents, or at least in California where you have rent control, it's affecting the ability of the apartment owner to maintain the facilities.
That's absolutely true. I was talking to someone yesterday on the phone, and they were asking me about whether they should sell their condo, rental condo, or their units that they want to rent out. And we talked about insurance, and insurance definitely is one of the concerns that he had. In whether to keep the property or not. So it's definitely something to be concerned about. We did have, 12 months ago or a year ago, we had an availability issues, right? We have an insurance availability issues. Many people were not able to get insurance, but now we may actually we haven't turned a corner, but we actually have uh, transitions more from the availability issues to an affordability issue. Because, even if we were to keep, even some of the insurance companies were to stay here in California, they're going to increase their premium. So it's going to affect not only, the homeowners, but also multifamily property owners as well. And that's definitely true. Now, because people cannot afford to buy a home because of insurance costs, because of interest rate costs, take a look at what happened. Now, in 2021, when interest rates start rising, a lot of people cannot afford to purchase a property, but also because of how tight the market has been, housing market, people turn to the rental market. Take a look at the vacancy rate. Now, the vacancy rate in 2020 was at around 6% or so, a little bit about 6%. It started dropping to about 3.3% in California. That's because a lot of people could not buy a home. They flood to the rental market and rush to the rental market to rent. At the same time, though, builders, developers realize, hey, there is a market. A lot of people are actually looking for apartments or multifamily units. So they built a lot of multifamily units in the next couple years or so, which prompted vacancy rate to actually start rising. You can see the orange line right here, which is California. It's actually reached a point where it got to maybe about 5%, 5.1% or so. But look at how it compares to the pre-pandemic level. It's still slightly below the pre-pandemic level, even with all those increase. And you can see starting in 2024, we're actually seeing some plateauing in the vacancy rate in California. So California vacancy rate actually has been trending down, so showing some improvement. Very different from the national at the national level. If you look at the national numbers that continue to increase, it will probably likely to continue to increase in the upcoming months. It has reached 6.9% as of March for apartment lists. So there's a little bit more way to go at the national level in terms of vacancy rate, but California might have turned a corner and things actually started improving. The reason why I want to point this out is when you have vacancy rate start improving, that also means, rental, as far as average rent is concerned, it actually could actually start improving a bit more. Now, I want to point this out, as far as supply is concerned, I mentioned earlier the vacancy rate dropping started increasing because of increase in supply of housing production. At the national level, you can see this blue line right here. The total productions of all housing constructions, including single family and multifamily, increased until maybe about 2020, late 2023, it started dropping, still actually producing more so than the pre-pandemic level. But if you look at the 5 units or more multifamily, the light orange line also increased significantly until maybe late 2023 and it started coming down. So with supply tightening up, average rent should probably improve, especially in California. And that's what happened in California. Look at this orange line right here. For the last few months, we actually have been showing some positive growth. 1.7% at the latest with the latest number, which is March 2025 number. So we'll probably be start increasing a bit more. So as far as rent growth is concerned, things are actually going to look a little bit better in California. But I'll have to remind everyone again, this is somewhat backward looking because we're looking at a number before all this tariff turmoil.
Well,
So
not just tariff turmoil, but look at what's happening with deportations
uh-huh.
and border crossings. And I just saw a headline yesterday that said that the that ICE is going to start imposing fines of up to was it $998 per day
Yeah, I
for
saw that too.
people staying in the United States illegally and not self-deporting. So, have you had a chance to think about how the change in illegal status and people crossing the border and staying in the United States without a visa or work permit, how that is going to impact on your projections?
Yeah, there are a couple of things that we can talk about, as far as, the mass deportations, how it impact, the market as well as the economy. So let's talk, let's look at it from, a couple perspective. From one perspective, when you have mass deportation, more people leaving United States, more people leaving, leave the state as well as the U.S. That means, population growth or a number of people who live in the area in the US and in California may be not as many. So that actually could affect demand, housing demand, more likely in the rental market. So the demand may actually soften a little bit as far as, the number of apartments being occupied if people start leaving. So that's one way to look at it because we will be seeing fewer demand. But on the other hand, um, there's something that also could affect the supply side. When you probably are aware, many of you are aware, many of the people who were deported or about to be deported, they could be in the constructions industries. Many of them work in the constructions industry. They're in the labor force of the construction industry. If all of a sudden we have a lot of people leaving the constructions industries and the leaving the construction industry, that actually could mean a lot of people. There will be a tightness in terms of supply in the construction industries, which we actually have been experiencing even before the mass deportations. So on the supply side, that actually could boost construction costs, and that also could mean some of the projects will get delayed. So on the supply side, you might actually have fewer productions, fewer units being produced, um, which in that sense could actually push up, the rent growth. But then you also have some demand side, on the demand side, some slowdown. So that will be interesting to see which side actually could actually have put more pressure. Whether the demand side putting a little bit more downward pressure, or the supply side putting a little bit more upward pressure because it's tightness of supply. Now, my belief is most likely the demand side is going to take charge first because we do have more supply than that we have built a bit more supply in the last couple years or so. So the demand side is probably going to put a little bit of pressure on the rent growth, the average rent growth. So that's my speculation. But of course, that also we haven't really talked about, the how it impact the entire economy. I
Right.
think one of the questions that one of the um listeners before might have asked about um, unemployment rate. Um, how the mass deportation could actually affect, the unemployment rate. Now, it's also a multi-side perspective. With more people leaving California or leaving the U.S., it's very likely that, of course, we have a smaller labor force, right? We have a small labor force. So hypothetically speaking, if we hire the same number of people, where we have a smaller labor pool, we have more opportunities for those people who stay behind or in the job force, right? So, as far as unemployment rate is concerned, it should be a positive. But at the same time, we neglected a few things. Those people who were people who left because of mass deportations, they were also consider this. They were also consumers. If when people leave, the labor force, they're also not spending, in the US or in California. So there's going to be a drop in consumer spending because of that reason as well. On the other side also is forget about just the mass deportations or labor force shrinking. If the economy actually start having some issues because of tariffs, because of us going into recessions because of trade war, the general economy is going to actually drop. That means companies and generals are not going to hire as many people. That means unemployment rate could rise. So it's not just about, how many people are going to be leaving California, but also the economy is shrinking because of the concerns that there will be tariffs, trade wars, but also um, very something that we notice every day, hard not to notice, is of course it affects it affects the financial market, the stock market. People probably feel less wealthy because of stock market actually dropping quite a bit. So that actually affects people's desire to spend. So there are a lot of things that affect, intertwine with, the mass deportations that actually are affecting the economy, and then of course affect the multifamily market.
Right. While we're talking about rents and things like that,
Uh-huh.
Sharon has asked us if you have any data on how rent control has impacted the market here in California. I mean, because it's statewide rent control, I don't know how easy it is to judge that impact, maybe versus other states or something. But do you have any comments on that or any data on that in your presentation?
I don't have data in the presentation and the current presentations, but I can talk briefly about it. I've had some questions from many people in the past about, okay, well, rent control is definitely a factor that affects, the vacancy rate and rent growth, and that's probably very true. Now, in certain areas, let's focus on the local areas first before we talk about state. Um, in some of the local areas, certain areas, they're actually they have stricter rent control than other areas. Someone told me in the past that in LA it's really tough to have a property, and that's why a lot of people actually decide not to purchase a rental property in LA, but then instead they move to some of the other areas that might have a little bit looser rent control, maybe in San Diego or some of the other area that might be a little bit more um, inland. But you can also say the same argument at the state level for some of the rental properties outside of California. They may not have as strict a rent control as compared to what we are seeing in California. And of course, some of those properties outside of California could be a little bit more affordable in terms of price. So I think, in California, that actually the rent control especially with, what we're seeing, what additional restrictions being added to California in the last couple months or last few months or so, it's because of the wildfires. Because of the wildfires, there had been observations of rent gouging. So there have been some restrictions being put on, the rent control front. And now I'm not an attorney, so I don't remember, all the rules that they have implemented. But Gov Hutchinson, who talks about our rent growth, is a good source to go to and ask about, how rent control actually have been implemented. So
So
Chris,
Gov is a CAR staff member, correct?
yes, he
Is
is.
he,
He is.
and what's his position there or title or?
He talks about, okay, so he's in a government, he is in our legal department, and he talks on a regular basis every couple months. He's a VP. On every month he talks to many different associations about, what's going on with the new laws of, in California. So strongly recommend, Chris, you to invite Gov Hutchinson to
Hmm,
one of your sessions to talk about the latest rules on both the residential side as well as CRE side. And you'll
sounds
be
great.
amazed by, his discussions because he's very, very knowledgeable and of course very funny too about
Yeah,
what's
I've
going
heard
on.
him a couple of times.
Yeah.
So I was just noticing the time. We're
Uh-huh.
having such a good time talking here that I think we're not going to get through all your slides unless we get back to it.
Okay, I'll speed things up a little bit. So I think we have talked enough about rent control. Let's take a look at some of the other things. Of course, some of the fundamentals, some of the things that people look at as far as, individual CRE property is of course net absorption. You can see in the red bars right here, things actually start picking up at the end of in 2024. As far as multifamily net absorption is concerned, it's actually start improving, and that's because of that tightening up in supply. But, if you look at, how it compares to previous month, yes, or previous quarter, it started rising, but you can see actually it dipped a little bit in the fourth quarter. So we slipped, but remain very, very positive. In terms of so, and we'll come back to multifamily later on when we talk about outlook. We want to spend some time on some of the other properties as well. Now, we talked about multifamily and we discussed, what happened, how the economy might affect the multifamily sector and apartment sector. But there are other issues as well. Um, the macroeconomic performance of the economy definitely have an impact on retail sales. Now, I earlier I mentioned about consumer spending. That's a big part of, the growth, the economic growth. So let's take a look at the consumer spending, and then to see how it affect, the retail side and then retail space. If you look at the latest monthly number on retail sales, you can see the very first line shows the retail sales number on how it changed on a month-to-month basis. It actually only inched up in February by about 0.2%. That actually is one of the lowest levels that we have seen. I think it's the lowest that we have seen since maybe um, in the last 6 months or so, except for January, which actually dipped. Now, the January number of a pullback in 1.2% could be just a decline due to that pulling forward at the end of last year. But when we start consistent softness in retail sales in February, we should start worrying about, what could happen. This is again before the tariff concerns, tariff turmoil. So we probably could see smaller growth in the upcoming months because of that reason. Now, smaller growth means, of course, it affects the bottom line for many of the retail space. I pulled some numbers again from Wells Fargo and CoStar. And if you take a look at the net absorption rate for retail space actually remained positive. In fact, it remained positive for the last 3, 4 years or so. And the reason why that is the case is retail space actually have not been building a whole lot. There has not been a whole lot of supply in the retail space. And so it's actually remained at a positive number, and it's stabilizing to a level that is similar to what we saw in the pre-pandemic level. So as far as retail space is concerned, I think, yes, compared to 10 years ago, 15 years ago, we may be because we switched to a lot of online spending. Maybe we may not be going to the store We may not be going to a physical store as much as before, but there are still a lot of demand. If you take a look at, what being absorbed in the last 12 months or so, take a look at the net absorption. General retail and strip centers actually made up most of the net absorptions. In fact, I think the general retail make up about 90%, a little bit over 90% of the positive net absorption rate. Neighborhood center also is doing okay, but then you can see that the neighborhood center, the green line right here, actually started declining in the last couple of years, even though they might have some demand, but the demand actually has come down a little bit. And you can see the supply and demand side here. I know it's a lot of bars right here, but look, focus on the vacancy rate right here, the red line right here. You can see that the vacancy rate seems like it's stabilizing, continue to actually look at stay at maybe about 4%, 4.1% or so. Now, during COVID, we had a surge, in vacancy rate because, of course, of the shutdown. That actually stabilized a little bit. It actually, even though, vacancy rate continued to stay at a low level, but remember, supply remained very, very tight because people are not putting up supply. And that actually affects, the asking rent growth, even though it actually is still a positive number. So that is going to put some downward pressure on rent growth. Now, I mentioned retail is still there. We just have to figure out, what, people are looking for. If you look at the net absorptions, if you look at malls, malls are definitely, we still have a lot of malls, but they're changing their layout, they're changing their demand. I think, the restaurants, fitness centers, beauty and Medicare, those are things that are driving up the demand. People are more concerned about their wellness, rather than, going to a store to buy a products. You can do a lot of those online now, but people are focusing on experience. Some of the other locations, such as grocery anchored neighborhood shopping centers, those are also in high demand. So keep that in mind. And of course, one of the things that people are concerned about is retail sales also in the last few years, I think things have been improved, but in the last few years, there have been a lot of loss to theft. And that actually caused retail space or retailers to be concerned about, and that affects demand for retail space. And if you take a look at the retailers in California, they lost close to $9 billion in revenue to theft in 2022. And the average shoplifters is only arrested once out of every 100 incidents. That actually adds to the cost of, of course, retailers, and that affects retail space. Now, let's talk about industrial space. I mentioned about online sales. E-commerce. If you look at e-commerce retail sales, it has ballooned all the way up, in 2024 to close to 300 billion. It's very easy, right? We go online, we buy stuff, and then we have them shipped. And during COVID again, we had a spike, came down, but it started rising again. Now that spike actually increased supply in the industrial space, and we had a lot of supply being put out, and builders started building a lot of industrial space, and we did have a lot of people buying online. But net absorption actually continued to normalize. We had here's the net absorption rate during COVID and a year before, a year after that. You can see that, you can see how it justified a significant increase in supply during the next couple years. And then with those supplies, of course, net absorption started coming down because we can do our own shopping now, not just online, but at the store. So industrial space actually came down a little bit, because of increase in supply, but also of a slight decrease in demand. Now, Amazon specifically, they pull back, from in 2023 and 2024, pull back on their expansion. Now, especially with what we're seeing right now in terms of tariff turmoil, there might be some issues importing goods from China, from other countries. So that actually could affect their industrial space demand. Um, and as you can see, vacancy rate actually had dropped in 2023 and then started rising because of those increase in supply. And that also applied a downward pressure on rent growth. But we do expect, take a look at the slide, we do expect new supply actually to start to continue to decrease in 2025 and in 2026 before bouncing back in 2027. Now, these numbers, they were of course projected before the whole thing about tariff. So most likely the increase or the supply in 2027, 2028 could have come down a little bit since after that.
So
The
before
last,
you leave industrial,
yes.
so the whole reshoring thing, as I mean, I heard yesterday that there have been more announcements of capital investment by companies like Hyundai and um, the type TSMC and all these other companies bringing manufacturing to the United States. And it seems like that would really be a boom for building of new industrial space. And it'd be a lot of demand coming on just because of reshoring.
Now, I'm glad that you brought that up, Chris. Now, uh, in before this year, before this year, even going back to 2017, 2018, the term reshoring was a little different because the reshoring was defined by maybe instead of manufacturing things in China or Vietnam, they actually put their factories in Mexico. So the reassuring back then was, okay, well, we have products coming in Mexico from Mexico to US to California. It's closer, it's not as expensive. So the definition was a little different back then. Now or I should call it nearshoring back then. Now with the tariff, of course, there will be plants, there will be manufacturing companies moving their plants to the US. There's no doubt about it. The question is, where, where, where are the warehouse going to be located? Now, in if we're looking at, let's say, some of the manufacturing companies or factories being located in somewhere within the United States, we have to look at the path, where they will be actually delivering their products. Instead of focusing now on, okay, we will look at the ports. We want to build warehouses that are closer to, or logistics that are closer to Port of LA, Port of Long Beach, and in the Bay Area, the Port of Oakland, they might actually have to consider, thinking about maybe warehouses or industrial space closer to some of the path that actually route the products to the state. So it's going to be interesting. I think with the supply that we are going on with the industrial supplies that are in the pipeline right now, we still have, enough space right now to supply in the next couple of years. The question is, where are those new industrial space are going to be built? But another question is that very important to consider, which I allude to in the outlook segment, is in that, when we build, that applies to industrial space, retail space, and multifamily. The cost of building is going to be a little bit higher because of
Mhm.
the tariff issues, because of lumber, because of gypsum, because of all those materials, building materials costs going to go up. That is also going to affect the bottom line of developers and builders as well. So keep that in mind. We might actually have a need for more industrial space, but for builders and developers, it might be a concern, but also the cost of building might be a little bit higher. So the cost for buying an industrial and warehouse distribution center might be a little higher as well. So those are some of the things to consider in the upcoming years.
Perfect. Thank you.
Sure. Now let's take a look at office space. Our last segment on property type before we briefly talk about the outlook. I know we have very limited time, but let's take a look at office space. I think many people already know, as far as office space is concerned, has been declining. The demand for office space has been declining because of remote working. Take a look at the number here. It was 63% at the beginning before the pandemic, maybe about 60 some percent people actually work in the office full time. But that number eventually dwindled. Only about 25% people, let me take that back. Sorry. 60% during the COVID actually work from home because of the shutdown. Before the shutdown, I think the percent of people who work from home, maybe about 15%. Now, mainly gig workers or so, but that number actually started actually compared to the pre-pandemic level, that number actually started stabilizing. Currently, we have maybe about a quarter, a little more than a quarter of the people work from home full time. That number doesn't seem like it's going to go down too much in the upcoming um, year. It's going to be an ongoing trend. I think a lot of people enjoy working from home, and they have the capability, technological capability to do so. And certain areas are actually more likely to have people work from home. If you are in a big city, the top 10 cities by population, 31% or a little bit over 30% actually work from home. But if you work in a small city, the number tend to be a little bit lower. And that trend is probably not going to go away, and that affects office space. And you can see the net absorption rate actually came down significantly in 2020 from 2022 through 2024. Now, even before pandemic, we have been seeing some slowdown in office space. Yeah, it fluctuates because of the fact that uh, people want to consolidate. May not necessarily need as much office space as before. So it has been consolidating anyway. But the COVID actually expedited the process because of expediting um, technological advancement. So as far as office space is concerned, we most likely will continue to see some slowdown, continue to slow down in the upcoming year, especially with some concerns about, the economy. Office asking rent growth continue to grow, but at a slow pace as compared to before. It's very, very low at around 0.1%, 1.1% on a year-over-year basis only, and will continue to stay at a very low level. And you can see right here, the supply of office space actually will continue to drop in 2026, 27, and 27 and 28. Now, you might be surprised why we actually had a little bit of a spike in 2025. And the reason why that is the case, office space, the overall categorization of office space, also include data center. Data center, of course, is something that, when we use a lot of AI technologies, a lot of people need, a lot of companies need data centers. And data center actually has boomed in the last couple years, last few years. The demand for the construction spending on data center actually increased quite significantly. Now, compared to general office building, it's still a small number, but you can see that we do need a data center, but it might actually happen in the next couple years. From that point on, it might actually slow down a little bit. So keep that in mind. Data center is going to be part of the reasons why we're seeing some decent improvement in the last year or two on office space, but from that point on, supply is going to probably start going down. Now,
That's really surprising that data centers are not industrial.
yeah, I thought that would be the case too, but then when I looked at, because I did a presentation for the construction trade association, and then I looked into it, I realized, oh, data center is actually considered part of the office space. So that's a little surprise when it comes to the constructions part of it.
Yeah, wow. Hmm.
Now, let's take a look at, I know I'm running out of time. I'm going to, may have to, skip some of the slides, but let's talk in general about what happened, in terms of what we can expect. If you look at the credit cards that first, let's take a look at the economy. What can we expect from the economy? Now, this is before the tariff turmoil again. Last quarter, fourth quarter of 2024, we looked at credit card debt, and we wanted to look at credit card debt and to see, if we have any issues there. When I look at the credit card debt, the total credit card balance, it actually increased to a highest level of all time. Now, that is not a surprise. People use their credit cards to for spending. Now, on one hand, you can think, well, people are still spending. That's great. We're actually hitting a very high level, but at the same time, using credit card debt, is there a concern? Now, I don't think there is a huge concern from just based on a credit card balance. But if you based on how many people are not paying credit card debt, then you should be concerned. Take a look at the number here. Again, it's a quarterly number. The last quarter, the percent of people, or the percent of people who went into delinquency, or percent of credit consumer spending went into delinquency, is a pretty high level. This is the blue line right here that says credit card right here. You can see that the percent with a delinquency rate, 30 days not paying for their transactions, is about 11% or so, or actually about 9% or so, sorry. Um, so that's a high number compared to, what we saw in the past few years. In fact, that number going back to that number is as high. The level of percent of people who did not pay actually went back to the level is about the same as what we saw in 2020, 2010 and 2011. 2010 and 2011, probably many of you remember, it was not the greatest time. We have better times before then and after that. Now, whether things are going to that rising delinquency, whether it is going to be an issue, we'll have to find out. If we start seeing more people get laid off, and if we start seeing more people going into default, that's concerning. Now, add on to that, of course, is the uncertainty that we have been seeing in the last few days, last few weeks about the tariff. Take a look at this chart right here. This was actually, this could be a little outdated now, but this was collected and put together by UCLA. They put together and Bloomberg. They actually look at like a schedule of what was previously proposed of how the tariff implementation will happen. Now, as I said, it could be a little dated because, we have already passed some of these states. But um, recently, let's talk, just without looking at the chart. Recently, we have already seen, what have happened. There's a blanket sweeping tariff being applied about a week ago, and then there's some retaliatory tariff being implemented by China. EU actually, I believe this morning announced that they will actually have some retaliatory tariff as well. Now, there will be some negotiation, but it created a lot of uncertainty. If you look at the chart on the right-hand side here, this is the chart called the Economic Policy Uncertainty Index. You can see that as far as the trade policy is concerned, take a look at this black dark line right here. That index, uncertainty index, actually shot up to a very, very high level. Um, I think the last time we have a level this high was maybe during um, COVID, maybe even earlier than that. But this is a very, very high level, and that create a lot of uncertainty for investors, a lot of uncertainty about, whether people want to buy or not just investors, but consumers. And that's why we saw that, that a lot of people will actually pull forward at the end of last year's on consumer products. Now, here are some of the things that shows you what might actually increase. Again, um, we import a lot of things from China, from Canada, and Mexico. Um, these are some of the products that we actually have more than 50% of these imports from these three countries. And if you look at these numbers, these items, you can see a lot of things could be affected as far as, produce, vegetables, in terms of toys, in terms of building products, building constructions, products, supplies. All these things are probably going to see an increase. Now, this was a chart put together and projected by Wells Fargo again. They actually suggested that with the baseline, which means if we don't have any tariff, then we're actually going to see inflation coming down in 2025 and 2026. Take a look at the 2026, the blue line right here. But with tariff, the number will shoot up. We could actually see inflation flaring up from what we had before, which was 2 point, last year was 3.3, 3.2%. Um, it might actually shoot up to about 4% in terms of with tariff. And it makes sense because take a look at this chart right here. All these different items have different tariff rate. When we combine everything together, we actually could have an effective tariff rate a lot higher. Now, this projections again was done by about a month ago. The current projections for effective tariff rate could shoot up to about 24%. The latest number that I have is 24%. Imagine all your imported goods. Many of us purchase imported goods. If that actually increased by 24, 25%, that's a significant increase. And that is going to affect our monthly expenses. And when was the last time? Just to put things into perspective, when we had 24, when we have 14% tariff effective tariff rate of 14%. Last time when we had actually a 14 or 15% tariff effective tariff rate, it was way back in 1920, 1930s. And that's when we actually had that's the time when we had a depression. Now, the tariff being implemented at that time did not cause depressions. Let me just be very, very clear. But it did prolong with the tariff, with trade war back then in 1920, 1930. That did actually prolong the recovery. So if we continue to have the 14, even now 24% effective tariff rate, that is going to lead to a recession and probably lead to a slow recovery. I'm going to skip this one. And of course, this is going to lead to a lot of consumers have already are very nervous. In the last few months, we actually have seen consumer confidence dipping. And it probably will dip again in the upcoming consumer confidence report, probably will be released in about a couple weeks or so. If you're curious, this Friday, we should have another report called the Consumer Sentiment. That actually is a measure that is similar to consumer confidence that actually will tell you a little bit more about whether people are confident or not about, the current conditions. And of course, the consumer confidence takes into account expectation as well. So people's expectation for what actually could come actually dropped significantly to the lowest level in the last 12 years based on this consumer confidence index. Um, there are a lot of things that actually could happen in between. Now, tariff, we have already mentioned a couple of things. Tariff and tariff is happening right now. We might actually have a tax cut later this year that actually should help boost the economy, so that's good. But the thing is, of course, when we have tariff, it's going to have an impact on inflation that I showed you earlier. Um, so all of those are also going to take into account or go into the mindset of the Federal Reserve. The Federal Reserve, the central bank, they are going to make some announcement. They're going to make some decisions on whether they cut rate or not. Previously, we thought rates are probably going to be maybe cut once or maybe twice this year because of inflation. Now, the Federal Reserve have two mandates, remember. They need to contain inflation, but they also need to make sure that the economy is okay, the labor market is okay. So they have a very fine line to walk in the next 12 months or so. They don't want to cut rate too fast so that inflation flare up, but at the same time, they're more concerned about, the economy actually dipping too fast. So I have a feeling that they probably will increase they probably will cut rates at some point, maybe in June. And they may actually cut it faster than previously thought. My predictions is probably instead of two times that was predicted before, they may actually cut it three times instead. And there are some investors predictions as well. I'm not going to go through this right now. Just want to give you a quick glance because I don't want to go through this slide because I know it's going to change next week. Investors are probably going to recalibrate, how many times the Federal Reserve will cut rate because of the situation being very fluid. We don't know what the negotiation is going to be like between China and US or between US and EU. So until we have some clarity on that, that's not going to be very accurate. Now, I want to show you one more thing about the CRE market. The CRE market, um, before the tariff turmoil, again, we have been seeing the delinquency rate for the CMBS delinquency for individual property actually slowing down a little bit. In fact, the overall actually has been dropping in terms of the delinquency rate. A look at industrial, look at multifamily, office, and retail. They're actually slowing down. The delinquency have been coming down, except for lodging. But because of the uncertainties that we have right now and ahead of us, there is a chance the delinquency rate for CMBS could actually increase, and that could actually create some concerns about some of the properties being default. CRE properties being default, and that could create another layer of concerns. Now, here is our economic outlook for the U.S. Um, I still believe that we are going to see a positive number for 2025 as far as the GDP is concerned. We're going to see an increase. And 2026, if we actually were able to pull it out at the beginning of next year, most likely, okay, let me step back. We're going to see the year to have a positive number of 1.4. But next year, but the second or the third or the fourth quarter of this year, second half of the year, we may actually see a negative growth. But hopefully we can pull it out in 2026. But as far as inflation is concerned, it may actually dip slightly, even though we have to anticipate a higher inflation for many of the imported goods. But the recession, well, I wouldn't say recessions yet, but there's a good chance that we might actually get into it. But the slowdown in the economy will probably lead to maybe some um, softening in inflation. So it actually will dip slightly, but it will continue to stay at a 2.7% this year. Um, and in general, we talked about insurance already, Chris. In general, um, the question is whether we are going to see continued increase in insurance costs. Well, to know whether insurance premium will continue to increase, we have to think about a couple of things. Are we going to have more natural disasters or wildfires? Are we going to have more inflation? The answer to the first question is if you look at FEMA's map, you realize there are all red, a lot of orange in California. That means we expect a lot of wildfires and loss to be expected to be high in California, and that's just the reality. Um, we had some rain in the last couple weeks ago, that helps, but we also should expect, a little bit more wildfires in the upcoming year. That means that is going to put some upward pressure on insurance companies. Even though inflation actually has come down in the last couple of years, you can see this chart right here. It was about 8 or 9%, and then it started slowing down to maybe about 4 or 5%. The insurance, the increase in construction costs actually has come down, but that was again before, the all these tariffs being implemented. Even for California, if you look at the construction index, actually it came down to 2.3%, which was great news. But, with tariff, there's a possibility that um, one company actually put together some look at individual raw materials that we need for to build a property. Um, when everything's being put together, it suggests that there will be an increase of about 5% in building a new home. So for the insurance company, they take notes, and that can mean that they actually will increase costs because of inflation and because of those wildfires. And State Farm, Allstate, they have already requested, increased in premium. And based on the projections from Nationwide, there's going to be a 9.5% increase in insurance premium in general at the national level for 2025, and then another 8%. Now, this again is before all these tariff turmoil. So the increase could be even higher. And this is actually before the wildfires as well. So um, there's a good chance that we could see some inflation. There's a good chance that we will see more wildfires. Then that means we'll probably will see insurance premium go up both at the residential level for the residential properties as well as commercial properties. Now, I have some projections here for multifamily, and then I'll have some projections for retail space, industrial space, and also office. Um, Really quick. for this US and also by individual areas, some of the individual areas in Southern California and Northern California. 2025, again, before the all these fluctuations in the market, we expect a rent growth of, a minor, a very minute, small growth in rent growth. I still believe rent growth should be okay in 2025 and 2026. It might take off maybe, a basis point, 1 to 5 basis point here and there in terms of rent growth. Um, Vacancy rate could be a little bit higher, as Chris and I talked about it earlier. There are a lot of different factors, the economy, but the demand of fewer people asking for rental properties could have an impact as well. It is going to leave a vacancy rate as a level a little bit higher than previously thought. Hopefully, it won't affect rent growth that much. I'm going to skip the builder's optimism for now, because I don't think that applies anymore because of, what's going on with rates as well as inflation as well as the cost of building. Um, but they do plan on the developers, they do plan on having new development at least before the tariff turmoil in 2024. About 75% plan on new development in the next 12 months or so, but that could change when we look at the numbers in 6 months or so. As far as retail space is concerned, I'm not too concerned about retail space because it start to have I shouldn't say I shouldn't be concerned. I don't think there is huge fluctuation in retail space because of how tight the market is in terms of supply. So I do believe that there will be rent growth, unless we go into a deep recessions. I don't think that is the case, even though we might actually have a chance of recessions in the second half of the year. I do believe that it's probably not going to be a sharp recession. It's probably going to be a slight dip. Um, and that will actually allow retail space to continue to grow at a very moderate level, though, in both 2025 and 2026. Again, the sentiment is predicated on how good the economy is going to be. There are a lot of questions that I cannot answer as far as how good the economy is going to go, because, as I mentioned, the sentiment actually might have changed for both investors, for both consumers. We might actually be spending less, and that actually could affect, builders and developers' sentiment. And I certainly think, fewer builders will be holding off on building retail space because of the current environment. Industrial space. Um, there also are a lot of moving parts because of all the imports. There will be a drop in imports. There's no question in the next 3 months or so. Until we straighten out all those tariff issues, there will be a drop. So some of the building projects will be put on hold for sure. And that could actually lead to, again, a little bit of tight supply, but at the same time, the demand may be put on hold as well. Rent growth may be actually what I am showing here for 2025 may be a little bit lower, when we take into account all those tariff issues. Vacancy rate probably will not be significantly different. Might be a little higher. Now, Inland Empire might actually see a little bit higher increase in the vacancy rate because of whether people are actually going to move their products or ship their products through the ports, or whether it will be reshoring, as Chris mentioned. Now, those are going to be development in the next 3 years or so. We will probably have uh, a little bit more clearer pictures in about a couple months or so, hopefully, hopefully. And again, forget about the sentiment for now. They were very, very positive before, but now it might be a little different. Um, Building activities previously, should be some improvement in Northern California. But if we are actually not doing as with shipping of imported products from China, from other countries, may not be as high as before, that actually could create an issue. And here is the final projections for office space. Office space, it again depends on remote working. I don't think the the fluctuation in the economy is going to hurt office space as much because we have already been hurt by, the remote working. But there have been discussions that, okay, maybe, when the government talked about and the federal government talked about, maybe moving people back into the office, other big companies will do so as well. I think they started doing it, but then the economy could actually start fluctuating, so that actually could lead to fewer office space. But at the same time, also to keep this in mind, I don't have things in actual numbers, but the federal government actually rent space from office um, property owners, office space property owners. But if the federal government is downsizing, they have already been canceling some of those leases. So that actually could affect office space rent growth. But I still believe they are going to be positive this year. Maybe not as high as far as the increase in rate growth and growth rate. Vacancy rate, it probably will start plateauing. It is already at a very high level anyway. So probably will start plateauing. And with that, here are the key takeaways. I know I go on too long.
No, but you
But
know what, Oscar? If you consider how many people are still watching the live stream versus our peak, we still have like 70% of the people that are still here. So you're
perfect.
doing great. This has been very, very interesting.
Perfect. I didn't realize that it's already 10 o'clock. I actually have a meeting at 10. But I'll wrap it up. We have some key takeaways here, of course. The economy may still post a gain this year, but the odds of a recessions actually have been rising. And I can't tell you how big of an odds is going to be right now because there are a lot of moving parts. Now, mortgage rates obviously continue to play a role in the supply and demand for most CRE property types, but we shift our attentions to tariffs and trade policies. It's still a lot of unknowns in that area, so I can't really tell you what is going to happen because I don't know if anybody knows exactly what's going to happen. Um, but as far as multifamily, retail space, industrial space, and the office sectors are concerned, um, original projections was they're going to grow moderately in terms of rent growth in 2025. That's the original predictions. But you have to take that with a grain of salt now. You have to actually take that, maybe move it down maybe about 5 to 10 basis point as far as the rent growth is concerned. But it, I think, in 6 months or so, if I were to come back, if you invite me back, yeah, I think I will have a little bit more information, hopefully. If we don't have more information, then we're in trouble in 6 months. Hopefully we'll have a little bit more information because hopefully things will be straightened out by then.
Yeah, I think we're going to have a lot of information 30 days from now.
Hopefully, I hope that is the case. Yes.
Yeah.
With that, I'm going to turn it back to you, Chris, and I probably need to jump off very, very soon.
Yeah, I've got one thing that kind of surprised me,
Sure.
and that is in looking at your projections
Uh-huh.
for LA County and specifically for your various things, is
Uh-huh.
the huge fires that were just down there, where over 13,000 structures were burned to the ground, both residential and commercial, that it didn't show a huge change in your percentages from other areas. And so I'm kind of surprised, that in your projections for LA County that it didn't show a lot of difference just because of that huge impact those wildfires had.
And it's true, when we talked about wildfires, I used to have a slide that shows, what the LA County or LA area impact could possibly be. But the impact of LA fires, yeah, it's actually in terms of number of properties being damaged, it's close to 17,000 actually, but about
70?
17.
17. Okay.
About 13,000 of those are residential. Maybe about a couple thousand, 2,000, 3,000, or maybe commercial or some of the top properties. So we will have a lot of buildings going on, well, building and activity going on in Eaton in the Pasadena area or in Pacific Palisades. So that actually is going to pull a lot of the construction and builders and developers into that areas. And so you're going to see some slowdown in terms of the supply side or the building side. That actually hopefully that helps, slow down the supply side and actually could lead to more stronger growth in terms of rent growth and maybe slow down the vacancy rate. But at the same time, that actually could pull away some of the material that actually could increase cost of building for some of the other, so for the cost of building. So that actually could add on to that inflationary effect. And now,
Hmm.
at the same time, not on the supplies or the constructions activity side, that is also going to, with all those, with those two areas or other areas actually losing homes, losing people who live in the area, that actually cause the economy to slow down in those areas as well. That means we're going to see pretty significant pullback in economic activity in those areas. But for the LA County as a whole, it may not change a whole lot for the year. For the first 3 months, first 4 months or so, the LA County may see some slowdown in economic activity, and then it start building back up because people will start spending somewhere else. And and this is anecdotal. For people who live in Pacific Palisades, I heard that they may be actually moving or not moving, but they may be looking for rental properties in Orange County. That you
Hmm.
may actually know a little bit more about that than I do. So that actually could put up some upward pressure on, properties in Orange County, multifamily properties in Orange County as far as rent growth. But again, that wildfires, of course, has this huge impact. But compared to the national impact of what we're going through right now, that may not, it may be overshadowed. Um,
Yeah.
so, you know, it still comes down to, what we can expect, with all these negotiations and trade talks. Hopefully, we will see some positive very, very soon, like maybe in 30 days or so, as you said.
Well, I found this very fascinating, and I know the people watching did too. So thank you very much for
You're welcome.
refocusing your presentation to include commercial real estate and giving us a lot of insight on that. And Oscar, it's been great. We look forward to having you back in about 6 months. So let's schedule that before too long so we can put it on our calendar.
Definitely send me an email and I'll put it on my calendar and I'll see everyone in 6 months.
All right. Well, you've got a meeting, so we're going to let you go. Thank you very much.
Thank you, Chris. Have a good one,
And
everyone.
thank you, everyone, for joining us. Please visit rcaoc.org to learn more about the Realtors Commercial Alliance of Orange County. All right. Take care.